Hey, good morning, everyone. Marty Mazzora here, 15th of December, 2022, Thursday, with a quick technical market snapshot for you. Wasn't able to get one out to you yesterday. We'll try to get one out tomorrow or over the weekend. We'll definitely be scoring our economic index. That happens every week, rain or shine. And typically, as you know, I tended to give you a video snapshot of the economic setup as well. We'll see if we can do that. What's going on here personally is we're moving residences, so a little bit hectic here and there, and kind of get in the way of things like shooting a video, which after the editing and everything else takes a while. But of course, everything else, clients, is going on every day as it's supposed to, regardless. So anyway, and ironically, it's been quite the week, so I've been really itching to get this out to you. So we'll go ahead and I'll do it right now, and we won't look at any supportive or related asset classes like we did the last time we looked at the dollar and bonds. Those are impactful here as well, I think, and they give us a message about the overall state of affairs. And we may be seeing a little bit of a shift in terms of what's motivating the action. And I alluded to this last time. Maybe there's some little hints that the market's going to start trading, down on bad news because it's been trading up on bad news. But I'm not so sure that's fair just yet. But when I look at bonds and I look at long-term treasury bonds, which are rallying a little bit today, against a backdrop where Powell came in terms of what he said, hawkish, more hawkish than the market expected. He did offer the bulls, some tidbits here and there, data dependent. We will be willing to change our tune or our methodology, words to that respect. When inflation begins to slow, it's been encouraging lately and so on and so forth. But on balance, the message was, we're going to stay higher for longer than the market thinks. Now, stocks were trading down overnight in the futures pit for sure, and it was going to be noticeable. What really made today really noticeable was the European Central Bank. I listened to most of Christine Lagarde's press conference, and if Powell was a hawk, Lagarde was a golden eagle. She was tough as nails in terms of their resolve to kill inflation. Clearly, she knew that she was tanking the European markets and the US markets with her commentary. I mean, she, in no uncertain terms, and I think she may have even said, in no uncertain terms, there is no pivot on the horizon. We are not pivoting. We have a ton of work to do, and we're going to fight inflation even if it kills us. I mean, it was just insanely, relative to what you expect from the European Central Bank, hawkish and aggressive in terms of interest rates. Somebody asked her about, look at what the Fed's doing, yada, yada. And she said, listen, we are behind the Fed, right? We have some catching up to do. So everything she said would just make the bulls run for cover. And that's what's happening. European stocks are down over 3% this morning, but the S&P is still down close to 2.5%. The NASDAQ is down 3.25%. So now let's get to that sentiment. What's moving the market? So again, I mentioned that bonds are actually rallying a little bit today. Treasury yields on the long end are coming down a little bit. Well, you wouldn't expect that unless you thought perhaps that the economy may be weakening. Now, over the years, over the decades, when people would come to me and say, I know they're going to raise interest rates, and that means mortgage rates are going up. And I would say, well, maybe. There will come a point in time, as it seems like always happens, where the Fed does too much or the market now flips to where it fears that it's about to do too much. And doing too much means you constrain financial conditions to the point where you cause a recession. And that's really the setup that goes into next year. That's a big part of our recession thesis, frankly. So there'll be a kind of a pivot for markets where the news now, the bad news, and there was some this morning that says, hey, this is economic weakening stuff, therefore the Fed is going to soften, sends the market up. But not if the market's already begun to believe that a recession is coming. And the news this morning was poorer than expected retail sales in the US. And the market actually traded down immediately on that news when it came out. Now, up until recently, that would have been something to celebrate in the markets because that says economy's slowing, consumers slowing down, the Fed's going to have to quit raising interest rates. It did the opposite, which says maybe for the moment that the market's saying, uh-oh, recession's coming, earnings are going down, stocks are going down. And that's our thesis for the second leg lower in this bear market. So there's that. There's also under the surface, and the past few months I've talked a lot about this. We've gotten really a lot more intimate on what's going on in the options world and how that impacts broader markets because so many people are trading options today. And there is an absolute avalanche of people who are trading 0 day to expiration options. They're using the leverage of options to speculate and literally day trading options. And what happens is on the dealer end, if they're selling, billions of dollars worth of call options, they expire the same day or the next day. Those dealers are on the hook if the market goes to the moon. So what happens is they have to hedge, and that hedging, believe me, has a real impact on the direction of the market. So if you're selling calls and the market goes up on you, well, you need to own that underlying so that you protect yourself if you're short the calls, if you're the counterparty to that call buyer, and so obviously the buying on the part of dealers then pushes the market higher. So when those calls expire, right, then obviously that hedge, that long position by the dealers is no longer needed, so they sell that. And there's a kind of a reverse situation that goes on at certain levels. On the downside, if people are loading up on puts today because the market's falling, well, the dealers have to hedge that put exposure by shorting the underlying stocks. Well, then what happens when those puts expire or those people close those positions? Well, then they close those hedges by buying the shortest stocks. Now, folks, I know this gets deep into the weeds, but there's that element going on under the surface, which I think the regular day, everyday, or retail investor may not understand and misinterpret what's really going on. Sometimes these big moves have nothing to do with fundamentals or real world, corporate earnings, prospects, and so forth. It has everything to do just with very short-term positions, the kind of which I just tried to explain to you. So then there's just the technicals. Lots of people trade technical indicators and moves in the market and the shapes and momentum and things that they take on the screen. That's why for years I've made it a point to study technical analysis formally and informally and do it a day in and day out and learn from it, and to the point where I'm comfortable showing the videos to you and talking about what the prospects are from a purely technical perspective. And by the way, this is something that we perform on every position in our core portfolio periodically. And again, we don't make big long-term moves based necessarily on the day-to-day technicals that I'm showing you here, but it might help us from an entry and an exit standpoint and so forth. So anyway, without further ado, you're looking at the daily chart in the S&P 500. Talked about what clearly is inspiring this big down move, this gap down, and then just a really sharp move lower, right? Remember up in here, the term I've been using the last 2 or 3 videos has been ambiguous. A lot of that's been on the hourly chart, which I'll show you right here. Remember, we pointed to the importance of this yellow line right here, the 20-day moving average, and how important it's been as a technical indicator throughout, and we broke above it. And then we broke below it here, and this started to look pretty bad until we got softer than expected CPI, yada, yada, and we shot above that, closed above the 200-day moving average. But remember, another thing I've been saying lately is there's a huge amount of overhead resistance, and you can see the market just pounded its head against that wall there, that ceiling, which is the bear market trend line, and came off of that and is now falling somewhat precipitously today. Okay. Now, according to our experts in the options bit, they've drawn a range between 3,900 and 4,000 today based on where they see the exposure, and that's where they expected the market to trade. If it were to really break down below 3,900 and pierce 3,800, then there's really very little by way of support below that area. They're not inherently bearish at the moment, but they are saying that after tomorrow's big expiration, a lot of the stuff gets kind of clean slated, if you will, or the slate gets wiped clean. Then we got to see what's going on, beyond that, and where all this positioning comes in, and what it means for between now and the end of the year per se. So can get pretty precarious. And again, when I talk about something awful happening below 3,800, what that's all about is where the exposure is happening, it going away, puts coming in, or existing puts or what have you, and the dealers continuing to have to hedge their downside exposure. So remember, back months and months ago, we drew our target at 3,500, hit it, and bounced right off of it. Felt pretty smart there, but by the time we got there, I said, folks, when we made this assumption, we weren't looking at recessionary conditions. We are now. And so this can be explained by rising interest rates and falling stock valuations relative to higher interest rates. The rest of it, if indeed we have a recession, can be explained by very disappointing corporate earnings. And we think if that happens, we think it's likely to play out the first half of next year. And then we think our long-term thesis really shines based on how we see the world today, always subject to change. It's a daily, day in, day out, week in, week out, month in, month out, yada, yada process. And we're not wedded to any of it. It's just do the work, make your risk reward assessments, and act accordingly, and be willing to see some pretty ugly days like today. We're certainly feeling this today at our core, not to the extent that the S&P is, but plenty relative to what we're used to. But that's part and parcel to the landscape. It's not the day-to-day moves. It's, are we positioned well from a longer term perspective? And something super precipitous to the downside, are we hedged? And that's where we use options in our core portfolio to mitigate, the worst of those kinds of drawdowns. And clients, you've actually experienced that action over the last couple of years, so you know what I'm talking about. Meaning that hedging doesn't mean we don't have drawdowns, but the hedging sure does help on a large scale when it happens. Okay, so we're finding some support right above the 50-day moving average. For the last 3 or 4 hours, the market is held below the 3,900. Nick and I just got off the phone a little bit ago with our morning session. I said, it'll be interesting to see. This market could get sucked back up to that range by the close. And ironically, here we sit at 39.04 in real time. So we've come back up quite a bit from the very low, still down a good chunk. S&P still down 2.3% on the morning. Short-term traders, good luck to you. I don't think I'm giving you much help right here. I would say that if there's a big, huge play to make money on, it probably is on the short side, meaning that's where you're going to see the biggest potential move. And I say that because we still have just a ton of overhead resistance up here. Their swing traders might do really, really well, in here if they can find a range that people are really playing. So time will tell. And actually that will play out over the next few days. And then super quickly on the hourly charts, again, we've had this, this long rising wedge pattern with bearish divergences, if you recall. And I said, that's just a real ugly look. And here's how that played out. I was surprised that we didn't get more of a sell-off based on that setup. But, factors came in, favorable inflation data and so on. But now we are getting, more of a sell-off. You notice right here, we came up literally to the exact same spots. We have kind of a double top right there. And we did that with a continuation of our bearish divergence here on the MACD and with a pretty strong sell signal right in here. So as I mentioned, the market's trying to fight its way back up. This is a delayed chart. We're actually about 10 points better than this. Trying to hold above that 3,900, which is supposedly where all that options exposure sucks the market to, between 3,900 and 4,000. Could absolutely see a big pop coming back up and testing these again. I would say right now, technically speaking, the edge probably belongs to the bears. Fundamentally speaking, we're not optimistic first half of next year, but we'll circle back and give you more the fundamental reasons on the written blog and more of the technical reasons here on the video. Folks, thank you as always for watching and listening, and I'll be back as soon as I can. Take care. Bye.